Welcome to Larraín Vial Asset Management's quarterly update on LATAM local currency rates. The first quarter of the year was unusual in that it was effectively split in two by the war in Iran, a conflict that began on the last day of February. From a performance perspective, the asset class was up a solid 6.4% until the outbreak of the war, and closed March at 2% year-to-date, still acceptable but less compelling. Note that GBIEM Global was down 5.6%, so LATAM has actually been relatively resilient. Of the roughly 4% loss during March, 2.7% was due to currency depreciation and 2.6% to capital losses, as yields repriced higher. Carry, on the other hand, contributed positively with 0.8%. Notably, FX and duration contributed almost equally to total returns, which is atypical. FX is usually about twice as volatile as the duration component. In March, the FX return was just under 1 standard deviation, while the duration return was 2 standard deviations. So, one possible interpretation of these market moves is that the energy-driven inflationary shock will be absorbed through tighter monetary policy rather than through weaker growth differentials, which tend to depreciate FX more heavily. So, focusing on the 5-year tenor across major economies for both nominal bonds and implied break-evens, i.e. the spread between nominals and linkers, we observed the following. In Brazil, nominal yields rose by 75 basis points and break-evens by 55 basis points. The currency depreciated by 1.1%. In Mexico, the most affected country in rate terms, yields increased by 85 basis points. Contrary to Brazil, break-evens were broadly flat, implying a rise in yields alongside nominals. The peso depreciated by 4%. In Chile, nominal yields increased by 45 basis points, while break-evens widened by 75. The Chilean peso depreciated by 5.8%, making it one of the worst-performing currencies across EM. Colombia was the outlier. Nominal yields declined by 30 basis points, and break-evens narrowed by 65, partly reflecting initial conditions. The Colombian peso appreciated by 2.1%. In Peru, yields rose by 65 basis points and break-even were broadly unchanged. The sol depreciated by 3.5%. Clearly, these are substantial adjustments in both nominal yields and inflation break-evens. Also, the adjustment was uneven. Brazil and Chile have pricing significantly more in future inflation than Mexico, for example. From a valuation standpoint, the move has created value where it was previously limited, in Chile or in Mexico, and pushed already attractive markets further into extreme valuations, the case for Brazil and Colombia. From a portfolio perspective, first, if the Middle East conflict persists, idiosyncratic dynamics are unlikely to dominate price action, making it a top-down approach more appropriate. Second, the current environment requires greater selectivity in active positioning, unlike the broad tailwinds seen earlier in the year. So finally, at these levels, the asset class now offers a blended yield above 10%, with currencies approximately 2.5% cheaper than a month ago, both attractive drivers in historical terms. While we don't want to hastily jump into a relief rally, we are aware that the global reallocation trade away from the US dollar might come back with a vengeance. So this has been a brief overview of LATAM local currency debt over the past quarter. For more information about this fund and any of our SICAV strategies, please visit our website.